Did you know that it's possible to get life insurance that will help you pay off your mortgage 5 years early? In this video, I'm going to walk you through exactly how to do that. In this situation, we're going to be talking about a married couple that have a mortgage of $300,000 that are paying a 4% interest rate, which is important. The policy that we're going to be setting up is best described as a fully loaded policy. And I'll explain why in just a second. We're going to be looking at covering the spouses for 25 years. And that's a very important number that I'll get to in just a second. And so what do we know about spouses? Again, in this example, we're talking about a family, husband and wife, let's say, a 40-year-old male and a 38-year-old female. Okay. Again, as I mentioned, they have a 30-year mortgage that they're looking to pay off. And what do we know about the course of 30 years? Lots of things can happen, which is why we get insurance to protect and mitigate against that risk. So lots of things can happen. Accidents, deaths, critical diseases can be diagnosed, all those sorts of things, which is why we have life insurance. But what's cool about this setup and the way we design this policy is that we're going to be talking about coverage for 25 years, okay? And for that coverage, we're going to be covering both, for this policy setup or policy design, we're going to be covering both the husband and the wife instead of just the breadwinner, which is important as well. So for this example, we're going to recommend $250,000 in coverage for the spouse, the husband, and another $100,000 for the wife. Okay, so we have a combined coverage of $350,000, which you'll notice is about 15% more than the $300,000 that they owe on their mortgage. Now, for the $100,000 for this policy, the monthly cost of that coverage is going to be $75.08. For the $250,000 in coverage, the cost is going to be $184.58. Okay, which is going to be a total of $259.66. Now, let's talk about the coverage. What's included in the coverage that we're talking about? We're talking about a policy, an insurance policy, a life insurance policy that has a cash back option, okay, which means at the end of the term, you're going to get all of your money back, which is a fantastic way to purchase insurance. Now, for the insurance coverage, though, not only do you get your premiums back at the end of the term, there's also living benefits that are included in this policy, which means if one of the insured is diagnosed with a critical, chronic, or terminal illness, they have access to the coverage that they purchased before a death were to happen, which can come in very handy. They also have a 25% accidental death benefit included as well. Both of these are included, living benefits and 25% accidental death, which means that if a death happens that is the cause of an accident, then they get an additional 25%. So if the wife in this situation were to pass away of an accident, and let's say a car accident, for example, the actual death benefit of that policy would not be $100,000, it would be $125,000. Again, these two things are both included. There's also riders available for specific situations, and all of this coverage is non-medical, meaning there's no urine analysis, there's no blood work needed, there's not a nurse that needs to come out to the home, which is also fantastic. So let's get back to the numbers. So we have a total monthly bill of $259.66. But what do we know? At the end of the 25 years in coverage, they're going to get all of that money back. So when you multiply $259.66 times 12 months times 25 years, that number adds up to about $77,000, $77,898. Well, guess what? If you look at an amortization table, okay, based on a 30-year mortgage for a $300,000 home, at the 25-year mark of that mortgage, we're looking up here, of the mortgage, guess how much money they're going to owe left on that mortgage? Well, about $77,000. So, what do we know? Well, we know at the end of the 25-year coverage, we're going to be getting just over $77,000 from our insurance policy, which would allow us to then turn around and pay off the mortgage 5 years early. So you get coverage for not only the breadwinner of the family, but also the other spouse. You have $250,000 in coverage for the male in the home, $100,000 in coverage for the other spouse. Your coverage is going to last 25 years. And at the end of that 25 years, because it's a cashback option policy, the insurance company is going to give you a check back for $77,000, which just so happens to be exactly how much you would owe left on your mortgage at the 25-year mark, then allowing you to pay off your mortgage in 25 years or 5 years early, which is a very, very huge perk. So this is how you purchase insurance, which allows you to pay off your home 5 years early.